Well, thank you very much for watching this presentation and hearing what I've got to say. Recently, I was asked by a shareholder, I was asked what I thought was an interesting question. And that question was this: Nick, why have you been so persistently buying shares in Finsbury Growth and Income Trust for yourself? And well, actually, I don't know if that is an interesting question, but I do hope that the answer to that question is interesting, because that's what I propose to talk about during this session. Let me say right up front that this is not a new phenomenon. In fact, I have been gradually accumulating shares in Finsbury Growth and Income Trust ever since Linsell Train Limited was appointed as its investment advisor. That's nearly a quarter of a century ago. But let today be the occasion that I share with you my 6 current reasons to be a personal buyer of shares in FGT. So, first, and I'm not going to dwell on this because this truly is personal to me and me alone. But first reason is this: it has been and it remains a privilege for me to be the investment advisor to this company. But with that privilege, in my opinion, comes responsibility. The fact is, as I'm going to remind you in a moment, the fact is we take quite a lot of risk with Finsbury's investment portfolio. And I figure that I shouldn't expect any other individual investor to take a higher proportional risk in Finsbury shares than I do myself. Does that make sense? It's almost my duty, I think, to buy shares in this company. Now, second reason I'm a buyer of the shares. Do you know, I think that this is actually quite a useful investment rule of thumb. This, as you see at the top of this slide, this idea that if you want to create wealth, you should concentrate your investment portfolio. If, on the other hand, your objective is to protect existing wealth, then by all means, diversify your portfolio. What I want to be absolutely clear about is that our objective with Finsbury is to create wealth for shareholders. And this is what really is the nub of the point here. The fact is that an investment trust is an ideal vehicle to run a concentrated portfolio of winners. I can concentrate Finsbury's portfolio much more than I could do, for instance, an open-ended investment company. And that latitude that the constitution of an investment trust offers, that latitude is the reason, ladies and gentlemen, the reason why investment trusts are so cool. So in corroboration of that concentration point, note that today we have 5 holdings in the portfolio of above 10% of net asset value each. Now, just a quick caveat, we do cap position sizes at 12.5%. So if a stock breaches 12.5%, we will reduce. Nonetheless, a quintet of holdings above 10% of NAV. They're there because over time they've performed well. This quintet I've rather brazenly dared to call the Magnificent Five, a Magnificent Five UK listed companies. And I have to say, to us, Diageo, Experian, London Stock Exchange Group, RELX and Sage, these are all evidently global growth businesses. And to us, at least, each of them is ostensibly undervalued relative to their growth opportunities and undervalued relative to global peers. Now, my third reason to buy the shares is that I like the portfolio characteristics of FGT. I like what the portfolio is concentrated on. And over this and the next slide, I'm just going to highlight a few of those portfolio characteristics. First of all, this is deliberately a big cap oriented strategy. And that is deliberate because we think it's the biggest companies and the globally significant companies listed on the London market that offer the best value. I'd also ask you to note the high and still at the margin growing exposure we have in the portfolio to best of breed businesses. To me, a non-trivial quantum of the portfolio is invested in companies that are number one, often in the world at what they do, or certainly a member of a small cohort of leading companies in in their fields. I mean, just in passing, and I just throw this out there almost as a rhetorical question, is there any UK company that is more dominant in its category in the world than Fever-Tree? Fever-Tree is orders of magnitude bigger than its nearest rival in the premium mixer market, for instance. Now, I also am attracted to these characteristics of the portfolio. Now, listen, I know we could have a debate as to whether or not a price earnings ratio on a portfolio weighted average basis for 2024 of just over 21 times. We could debate whether or not that is cheap or dear. What I would prefer to say, and this is a phrase that I've borrowed from another respected, in my mind, very respected shareholder in Finsbury Growth and Income Trust. To my mind, Finsbury's portfolio is reassuringly expensive. And what I mean by that is this: if this collection of companies can continue to earn a weighted average return on equity of over 30% per annum, as they're doing at the moment, and if our estimates of medium to long-term earnings growth of high single digits turn out to be realistic, then that combination is going to create a lot of future value for Finsbury shareholders. Value that one day I believe will be realized. Now, just at this point, I want to tie a few strands of what I've been saying so far together, and I'm thinking about the undervaluation, I'm thinking about investing in best of breed companies, and I'm thinking about return on equity. And what I thought I'd do here is just spend a minute or two talking about our newest addition to Finsbury's portfolio. I don't have a slide for it here, but it doesn't matter. So our newest holding, we've been accumulating this for 6 months. This is no big reveal or anything, but our newest holding is Rightmove. Now, I'm sure you don't need an exegesis from me about why Rightmove is a best of breed type company. As you know, it is by a considerable margin the dominant real estate property portal in the UK. It also, according to Bloomberg, has the highest return on equity of any holding that we have in Finsbury's portfolio today. Not surprising, given its capital light technology platform characteristics. Now, we have been buying Rightmove shares roughly 30%, maybe even a bit more than 30% below the peak share price that the company hit back in 2021. We've also been able to buy Rightmove shares on a 2024 price earnings ratio of around 21, 22 times. In other words, not far from the average price earnings ratio for the whole of Finsbury's portfolio. And there are a number of reasons why we've been able to accumulate Rightmove shares at what we think are these attractive terms. But perhaps the central reason is this. Rightmove has a new competitor, a US company, CoStar. CoStar has entered the UK residential portal market in late 2023, early 2024. And clearly, CoStar is going to have a go. And we will see. We will see whether CoStar is successful in taking share of eyeballs away from Rightmove. Other companies, serious companies, have attempted to do this in the past and have failed, but we'll see. We'll see whether CoStar can do Rightmove any damage. That's actually not the point I want to draw your attention to. What I want you to note is this. CoStar listed on NASDAQ, and it's a successful company. CoStar listed on NASDAQ, you have to pay over 60 times earnings to own the equity of CoStar. That's what you have to pay in the United States to own shares in a successful technology platform business. Again, I remind you, we've been able to accumulate Rightmove shares, another excellent business, on roughly a third of that valuation. Now, I'm sure that's an outlier. I'm not asking you to extrapolate anything radically from that. But what I would say is, to us, that anecdote about Rightmove confirms our general view that UK listed growth businesses are cheaply valued compared to their global peers. Fourth reason I've been buying shares in FGT. Over the last couple of years, the shape of Finsbury's investment portfolio has changed. It's changed partly as a result of a couple of newer acquisitions, including Rightmove, maybe one or two smaller disposals as well. But the result is that today, Finsbury's exposure to data analytics, technology platform companies and software companies, Finsbury's exposure to such companies is at its highest level, well, let's at least say over the last quarter of a century. Now, listen, I'm sure I don't need to explain to you why investing in data or software, why that is a compelling theme. But listen, if I had to characterize the opportunity in a sensational way, and I think I do want to characterize it in a sensational way, what I would say is that each of the 6 companies that you see on this slide, each of them has a current existing set of artificial intelligence powered tools which are being used to create new marginal value out of these companies' unique data. That value being created out of that data is highly valued by these companies' customers. Just looking at it, well, let me tell you what you're looking at here. This is kind of a checklist. It's a checklist that was created last year by Bank of America Merrill Lynch. We acknowledge and thank them for their thoughtful analysis. It's a kind of checklist of the criteria that Merrill Lynch believes will be necessary for a company to be a winner from development in artificial intelligence as opposed to a loser. And as you can see, the number 1 criteria, according to Merrill Lynch, for success is ownership of a market-leading data set. And I think it's so important to convey to you that the 6 companies that we're invested in, you see them here, they score well, in our opinion, relative to these criteria. So what am I saying? I think right at the essence of this is this. If you add together the FT All Share Index weights in each of these 6 companies, you get to just under 8% of the market is made up of these 6 businesses. By contrast, and as you can see, over 50% of Finsbury's investment portfolio is committed to these businesses. I don't know if that's enough. Maybe we'll have more. I think we'll buy more Rightmove, for instance. But what I do maintain here is that already we have created a highly differentiated exposure for Finsbury shareholders. We have a very substantive exposure to a collection of London-listed beneficiaries of developments in artificial intelligence, a higher exposure, I expect, than most other investors have attempted. And for me, at least, that is definitely a sensational reason to be a buyer of Finsbury shares. 5th reason, this long malaise in the UK stock market, so frustrating. It's thrown up value. I've got my top 10 stocks here. Just a couple. I've only got time to highlight a couple. And I thought I would say something first of all about a loser in Finsbury's portfolio, a recent difficult holding. On the far right hand of this set of charts, Unilever. Unilever has been dull, to say the best of it, over the last 3 or 4 years. Nonetheless, it does seem to us to be valid to look at the longer sweep of Unilever's share price history and to compare it to, well, in this case, the UK stock market, and to wonder what is it over long periods of time that actually has enabled Unilever to be quite a successful investment. And what we note is that over the decades, Unilever has done a decent job in shifting its portfolio of brands towards higher growth and higher margin brands over time. And to us, it's really noteworthy that today, over a quarter of Unilever's turnover is in its prestige beauty, health, and well-being brands. Now, if you look 10 years ago, effectively, Unilever had zero exposure to those categories. So it's now a meaningful part of the business. And actually, the companies say that over the last 13 quarters in a row, this part of its business has grown at double digits or near double digits. And to us, that's the explanation for why, yes, Unilever is a bit of a tortoise, but over time, it's turned out to be quite a competitive tortoise. Now, it's a good job that Unilever and its ilk don't make up all of our portfolio, and we need London Stock Exchange Group to work for us again. In particular, we need the biggest holding in Finsbury today. We need RELX to continue delivering what it has already delivered actually over the last 40 years. And I say 40 years because you may recall January of 2024 was the 40th anniversary of the first calculation of the FTSE 100 index. And RELX is one of the top 2 or 3 performers out of that original cohort of 100 companies. RELX, as you can see here, £100 invested in RELX 40 years ago with dividends reinvested would have turned into over £30,000 today. And when you look at the accelerating demand for RELX's data analytics tools, when you consider that this company is investing well over $1 billion a year into targeted development of new large language model or AI tools, then to us, there's every reason to believe that this company's best days are still ahead of it. Right, I've reached my 6th and final reason to buy Finsbury shares. And I am being candid with you. This is painful for me. But what you're looking at here is Finsbury's share price over the last 4 years and counting. And I've taken the share price from its all-time high, which I'm ashamed to confirm to you was as long ago as the 3rd quarter of 2019, a long time ago. It's frustrating for me and my team. We just haven't been able to get the portfolio clicking, or enough things working at the right time. The result of this lackluster share price performance is, not surprisingly, the shares have moved to a persistent discount. As a result of that, the board has sanctioned persistent share buybacks. Now, as a professional investor, I'm really quite mortified that this has happened on my watch. As a personal shareholder in the company, though, and I don't say this is a compensation for it, but as a personal shareholder, I can't help but note every time the company buys back some of its shares for cancellation at a discount, every time it does that, my own personal per share exposure to this collection of what I believe are excellent growth businesses, my own per share exposure goes up just a little bit. And that is the final reason, as I say, that I've been a buyer of Finsbury shares recently. To me, it's one of the cheapest stocks on the London market. And with each share buyback, it gets cheaper still. I sincerely hope that I'm right. And thank you so much for having got this far and listening to me.